When a private company wants to grow, innovate, or expand globally, it often needs more capital than it can raise through internal profits or private funding. One of the most transformative ways to raise this capital is by going public, through an initial public offering IPO. This chapter explains what an IPO is, how it works, and why it matters for companies and investors globally. An initial public offering IPO is the process through which a private company offers its shares to the public for the first time. Before an IPO, the company is typically owned by a small group of founders, early investors, and employees. By going public, the company invites outside investors to become shareholders by purchasing its stock on a public exchange. This process transforms the company into a publicly listed entity, subject to increased regulatory oversight, public reporting obligations, and of course, market pressures. There are several strategic reasons for a company to pursue an IPO. Raise capital for growth, expanding into new markets, R&D, acquisitions, repay debt. Provide liquidity to existing shareholders, including early investors and employees with stock options. Gain credibility and visibility in the public eye, and create a market for its shares, enabling easier future fundraising. The IPO process typically involves the following steps. 1. Appointing investment banks, underwriters. The company hires one or more investment banks to act as underwriters. Their role is to value the company, manage regulatory filings, set the IPO price, and sell the shares to institutional clients. 2. Regulatory filings. In the US, the company files a Form S-1 with the Securities and Exchange Commission, SEC. In other jurisdictions, for example, UK, Saudi Arabia, there are similar disclosures required by local regulators. 3. Due diligence and roadshow. The underwriters and lawyers conduct detailed analysis and legal reviews. Then, the company's executives go on a roadshow, a marketing tour to pitch the IPO to institutional investors. 4. Pricing and allocation. Based on investor interest, a final price is set, the offer price. Shares are allocated to investors, often with preference given to large institutions. 5. Listing and trading. The company is listed on a stock exchange, for example, NYSE, LSE, NASDAQ, Tadawul, and shares begin trading under a ticker symbol. Alibaba Group, 2014, listed on the NYSE, raising $25 billion, the largest IPO in history at the time. Saudi Aramco, 2019, listed on Tadawul, raised over $29 billion, now the largest IPO globally. Facebook 2012 raised $16 billion and marked a turning point for social media valuations. Adyen's 2018, Dutch fintech firm listed on Euronext Amsterdam, attracting global investors. Pricing an IPO is part science, part art. If the price is too high, the shares may not sell. If too low, the company may leave money on the table. Underwriters try to find a price that reflects fair value and ensures first a pop, a moderate rise in stock price once trading begins. Traditional IPO, shares are sold to institutional investors before the listing. Direct listing, the company does not raise new capital. Existing shares simply become tradable, used by Spotify and Coinbase. SPAC, a special purpose acquisition company. A public shell company acquires a private firm, effectively taking it public without a traditional IPO process. Investing in IPO can be rewarding but risky. Newly listed stocks can experience large price swings. Information gaps, less historical data may be available for analysis. Lockup periods, founders and insiders are often restricted from selling their shares for 6 months post-IPO. Early access to a company's growth trajectory. first mover advantage if the company becomes a market leader. Portfolio diversification, especially in emerging sectors. Historically, IPO shares were reserved for institutional investors, but now, more brokers like Robinhood, eToro, or Saxo Bank offer IPO allocations to retail investors, often with certain restrictions or minimums. An IPO is a company's first public offering of shares to raise capital. The process involves investment banks, regulators, roadshows, and market pricing. IPOs can provide growth capital and market visibility for companies. Investors can benefit from early access but must be cautious about volatility and valuation. Today, IPOs are increasingly accessible to global retail investors. In Chapter 3, we'll explore what share ownership really means and how owning equity in a company gives you power, profit, and responsibility.